So that covers the two types of stock spread trades. Now let's look at option trades. We have two types of spread trades for options too. And first we'll look at the option trade selection. This is the trade selection we use to select a directional trade in an option. And in our trade selection, contrary to what you may have learned, option trading doesn't have to be complicated. Our mantra is to keep it simple. Options are derivatives, and they derive their value from the price movement of the underlying stock. So call options profit as the underlying stock moves up in price, put options profit as the underlying stock moves down in price. And it's really the price movement of the underlying stock that determines the option's value and the resulting profit or loss for an option trade. So when we trade options, we're just looking, if we're buying a call option, we're just looking to buy a call option on a stock that's moving up in price. And if we're buying a put option, we're just looking to buy a put option on a stock that's moving down in price. So we don't get involved with all the Greeks in all those mathematical formulas that are out there for option trading. We simply follow the trend and we buy call options on stocks that are moving up and buy put options on stocks that are moving down. So if you can select a stock moving up in price using our directional trade selection process, if you purchase a call option on that stock moving up, that can produce profits as you harness the leverage that's provided by option investing. And we'll show you some examples of that. We use our simple trend following system for many years, and as I mentioned earlier, it works in both bull or bear markets. So if the stock is moving up in price, and that stock's on a buy signal. If the stock's moving down in price, the stock is on a sell signal. And of course, we buy call options on stocks that are on a buy signal, and we buy put options on stocks that are a sell signal. So that's all there is to it. It's pretty simple. We don't get involved in complicated mathematical theories and equations. We just simply buy call options on stocks that are moving up. So it only takes a minute to pull up these indicators on the internet to determine if you have a buy signal or not. So again, when we use a trend following system, that allows us to follow the current price trend instead of trying to predict the future price movement. And again, that eliminates emotional decision making and instead gives us the discipline to be successful option traders. And again, in the 2002 and 2008 bear markets, we owned bearish positions, and we were very profitable during those bear markets. So our
Chuck,
prime trade.
Sorry,
yeah.
Chuck, to interrupt again. I just want to let everyone know, and you as well, we're approaching 45 minutes, and I know you have a lot more information to get through. So for those of you, I know there's a lot of questions that are going unanswered at this point, but I want Chuck to get through his material. So I apologize for this, but we'll try to just focus on the rest of Chuck's presentation with the limited time we have. Thanks.
Okay, sounds good. Okay, for prime trade select, for selecting a directional option trade, we use the 50 and 100-day EMA to determine the price trend. Then we use the Keltner channels to select a low-risk entry. And then the third step for an optional direction trade is what we use what we call the 1% rule to select the option strike price. And I'll show you some examples of that. So the first step is we want to determine the price trend of the stock using the 50 and 100-day EMA. And if the 50-day EMA of the stock is above the 100-day EMA, then that stock is on a buy signal, and we want to buy call options. If the 50-day EMA is below the 100-day EMA, then that stock is on a sell signal, and we want to buy put options. And let's look at an example. This again is an example of a buy signal using the 50-day and 100-day EMA, and the blue line is the 50-day EMA. It crossed above the red line. At that point, Starbucks stock was on a buy signal, and we want to buy call options. So as long as this blue 50-day EMA is above this 100-day EMA, we want to buy call options on the stock. And here's an example of a sell signal, the FXI. The blue 50-day EMA crossed below the 100-day EMA, so that ETF at that point was on a sell signal, and as long as the 50-day is below the 100-day, it remains on a sell signal. So we use the Keltner channels to select a low-risk entry point, and as we mentioned, the Keltner channels are overbought, oversold indicator, and when the price of the stock is trading near the upper channel, it's getting overbought, and it normally retraces. We can see overbought, retraces, overbought, retraces, overbought, retraces. And so we don't want to buy a call option when the price of the underlying stock is trading near this upper Keltner channel. We want to wait till it retraces to the middle channel or the lower channel to select a low-risk entry point. So we don't want to buy when the stock is trading near the upper channel. We simply want to wait till it retraces to this middle or lower channel when it's getting oversold, and then buy the call option, and that will allow us to get a low-risk entry. And here's some actual examples. These were option trades that we took, and these stocks were on a buy signal. The 50-day EMA was above the 100-day EMA, and then we waited till the stocks retraced towards the middle or lower channel before we entered our call option. So here's an example. We bought the XLU. You can see was on a price uptrend. The price, daily price here is the red and black vertical lines going from lower left to upper right, so obviously on a strong price trend, so price uptrend. So the question is, where do you jump in if you want to participate? And we waited till the stock retraced towards the lower channel here, and then we bought the 42 strike call right here at 6:30. So XLU, strong price uptrend, waited till it retraced, entered by buying the 42 strike put, and then you can see that allowed a low risk entry as the stock went on to rally. Here's another example, the B&Q Real Estate Investment Trust, again on another strong uptrend, got overbought up here. We waited till it retraced and bought the 70 strike call at 1334. This is DVY, the dividend index. Another strong price uptrend, as you can see by the daily price movement, waited to retrace to the middle channel and bought the 70 strike call at 1170. Here's another example. This is Amazon, another strong price uptrend, waited till it retraced to the middle channel and bought the 330 strike call at 113. So here's a couple more examples. SSO, the leveraged ETF, S&P 500 ETF, waited till it retraced here, bought right in here, 65 strike call at 36, and then it continued to rally after that point. So the Keltner channels in these examples resulted in low risk entry as the stocks didn't retrace much from the entry point. So once we decide to buy a call option, there can be hundreds or even thousands of option strike prices to choose from. So we have a very simple rule of thumb, and that allows us to select an option strike price that has a good chance of being a winner. And we use what we call the 1% rule, and we want to limit the time value portion of an option to 1% of the stock price in order to break even on the trade. So option premiums, of course, consist of time value and intrinsic value, and options lose all time value at expiration. So when you buy an option, you always want to be aware that you're buying a decaying asset, because each day it's going to lose time value until you get to expiration, and then the option will lose all time value. So you always keep that in mind when you're buying an option, that you're buying a decaying asset. So with that in mind, we want to, when we buy an option, we want to minimize the time value because that's going to decay to zero, and we want to maximize the intrinsic value. And the way we do that is we limit the time value to less than 1% of the stock price. And if you do that, that will minimize the time value and maximize the intrinsic value. And let's look at an example here. If you buy a stock and it's trading at 100 and you want to limit the time value to 1% or less, then the time value portion of the option should be 1 point or less, which would be 1% of the stock price. So we'll look at an actual example here. So if you limit the time value portion of the option to 1% of the stock price, then the stock only needs to go up 1% in order for you to break even on the option trade and start making money. So that's not much of a movement, 1% move in the stock in order to break even on the option trade and start making money. So this will have, if you use this rule, you'll have a much higher probability of being successful than an option strike price that requires, let's say, a 6 to 10% increase in the price of the underlying stock to break even, which may never happen. And if that doesn't happen, then you're going to lose 100% of your premium. So we like to buy the in-the-money call options with that limits with a limited time value of 1% of the stock price. Okay, let's. And I just want to mention those examples of option trades that we took in the dividend index and the utilities index and Amazon. When we use the 1% rule for all those option strike prices. So all those stocks and ETFs, they only had to go up 1% in value after we bought that option in order to break even and start making money. So let's look at an actual example here. We bought the dividend ETF 70 strike call at 1170. DBY was trading, the stock was trading at 81.38. So this was an in-the-money call because we bought the 70 strike call at 1170. So stock price 81.38 minus this strike price of the call gives us an intrinsic value of 11.38. So the option premium, we paid 11.70. If you subtract this intrinsic value of 11.38, the time value was only 32 cents. So DVY only had to increase in price 32 cents, and this call would break even and it would start making money. And we also have an option calculator for call option purchases, and this will calculate the profit potential for the trade, assuming various price changes in the underlying stock, in this case from a 30% increase to a 5% decrease. So DBY was trading at 81.38. If the stock was flat at 81.38 at option expiration, we'd only have a 2.7% loss on the option, which is a lot better than 100% loss. So if you buy a call option and the stock doesn't increase above the strike price of the call, then you lose 100%. So in this case, we bought an in-the-money option. If the stock is flat, we only lose 2.7%. We can also see if the stock goes up only 10%, then we get a 66% return on the option. If it goes up 20%, we get a 136% return. So even though we're buying more expensive in-the-money calls, the stock doesn't have to go up that much and you'll realize a good return. So in this case, DVY only had to go up 32 cents or 0.4%, and this trade would break even and start making money.